Starting. So, good afternoon, guys, and welcome to the podcast. Happy holidays. Today, I've got Lee Mosbacker, founder and CEO of Cyrannus. And we're going to talk about all about what Cyrannus is. Lee has got a background. He's got a doctorate. He's a serial entrepreneur. He's got VC and a background in the Bay Area, now living in Ohio. And I'm really happy to have him on to talk about Cyrannus, what it is, and really excited to bring entrepreneurs onto the show. So Lee, welcome.
Thanks for having me. Excited to be here.
Yeah. So you have 25 plus years building, selling companies. You raised venture. Talk about your journey and how it led to Cyrannus, what it is.
Yes, I've got a technical background. Technical people think I'm a business person, and business people think I'm a technical person. So I straddle both lines. It's been mostly through necessity. I grew up to a few poor farmers in Ohio, and when I was a teenager, I used to run a lot of BBS systems and sell encryption codes for satellite dishes and fun stuff like that. And then I went to school for physics. And when I got out of my undergrad, I sold a company, a fintech product before fintech was even a label. And then went back to get a PhD, spun a company out of Ohio State, got me out to the Bay Area for a decade, got into artificial intelligence, mostly because of I saw the massive data sets and availability of high-end compute, and started building trading systems and found a partner that we traded with for 8 years. And then in 2021, during COVID, I moved back to Ohio, started getting into venture. So we have 3 funds now. Cobalt Fund is one. We did like average check size of 250, very early stage. I think we did 15 investments. And then being back in the state of Ohio, they've given us $5 million match to our capital. Now, I've never raised LP capital. As my partner and myself, we put our own capital in, and we started getting into venture. And that was when we had the idea for Cyrannus.
Mm-hmm. Yeah. And so diving into the question, what is Cyrannus?
Yeah, Cyrannus is Y Combinator meets Robinhood. So we're trying to get angels and early VC funds access to great qualified deals that are transparently evaluated by a mass audience of analysts and technical people and marketing people that kind of form a cohort around the deal. And then we use AI on top of that to give weightings and attribution to those decisions. And so we provide this access to this vetted deal flow. And then we wrap it all up in like an index fund that we can then bring investors on to buy chunks of that. And it's a very liquid fund, so they can buy and sell their positions whenever they really want. And we, as a sort of company, will invest in hundreds of deals over the years, trying to get to that critical mass of deal flow to where we've diversified the risk and we make it liquid. And that's really what investors are looking for these days.
Mm-hmm. So it sounds like Cyrannus solves the problem of venture. And talk about why venture is, most people, when they think about A16Z and all these, they think like big money. But you say venture is an unappealing and underperforming asset class, and Cyrannus comes in and solves the problems with traditional venture.
Yeah, I think if you're A16Z or you're another big fund, you can self-bake a lot of the success in your deals. But even those deals, when they hit public markets, they typically sail in the public markets. But while the investors in the VC funds are doing great, someone's left holding the bag, and it shouldn't be a zero-sum game for investing. There is that challenge, but I'd say the vast majority of VC firms lose money. The vast majority have a misunderstanding of what the power law really is, and they base an investment strategy around the power law, not really understanding what it's saying. And they have lockup funds for, could be 10 years, maybe 15 in today's market. And I think that's just become super unappealing to a lot of investors, especially where I live now, which is in the mid-continent. We're trying to change that. We're just trying to provide quality, transparency, and analysis of deals in an index fund format, and then add that liquidity option in so that you can manage your day-to-day finances. And we think that there are really interesting fund strategies around the liquidity portion that kind of take the power law out of the equation. And we think this is going to open up in investing to a whole new class of investor.
Mm-hmm. And I want to ask you more about the liquidity, but before that, because a lot of people are shut out of VC because they're accredited investors. If you like Cyrannus, does that allow the kind of retail or average mom and pop to get access to the venture capital pool, or is it how do you democratize access like Robinhood did for retail?
Yeah, so we only work with accredited investors or funds. We don't really have a desire right now to open it up to retail. I think that being said, though, that I would say the overwhelming majority of high net worth individuals that could invest in venture will never invest in venture until we have a platform like Cyrannus. And so if you look at the global VC market, it's probably operating at 1% to 2% where it could be operating at if they had these attributes in the asset class to offer other accredited investors.
Mm-hmm. Yeah. And talk about this. How do you solve the liquidity problem? Because in venture, usually funds are locked up for 10 to 15 years. So how do you solve that problem in like the legality, regulation, and all of that?
Yes, like a Coinbase, we're the custodian of the equities. So a founder will always see Cyrannus on their safe note, convertible note, or their cap table. And we do a private market swap on the back end to allow that liquidity. And we work with liquidity providers up to $7 billion in total liquidity. We have those partnerships to be able to buy those equities at A, B, and C. We invest super early. And our whole thing to the founders is we want this liquidity as an option. But what we can do for you is we can give you immediate feedback. We can take maybe a year off of your fundraise and we invest super early. So we get a lot of really great economics for being really early. And then we parlay that into the A, B, and C rounds for ourselves and our investors to exit those where other investors are willing to take on a different risk profile.
Interesting. So we talk about what's interesting is if people wanted to work with that, what you mentioned, what are the requirements? So you mentioned accredited investor. What is the minimum check size and how does all of the key product features work?
I think one of the challenges in a lot of angel networks and a lot of angel groups is that they have a lot of members that aren't active. So we require at least a 10K commitment to Cyrannus to have access to the platform. So we want to make sure that you're going to be an active investor. So that's like level one. But we do self-attestation for the accreditation. And we also have a company that we're working with called Verify that we're bringing in to verify the accredited investor. But really, there's a lot of money that can be made in the earliest stages of these businesses, especially since they're super early. You get advanced economics, and the data is pretty strong out there about how many of these companies actually make it to the A round, the B round, the C round. Just using that data and using that liquidity option, you can compound those liquidity multiples, much like an evergreen, and you can actually get to like top percentile fund performance with never having hit a unicorn, which is taking a lot of the luck out of venture.
Interesting. How does Cyrannus address counterparty risk to avoid things like a Celsius or an FTX or just like bad actors? What is your process?
I can't speak to Celsius, but the check sizes are pretty small. It's a vetted network. We're not making the decisions. We have a Wikipedia model around our expert evaluation network that qualifies deals, but we're never going to bake all the risk out of venture. There's always going to be risk. We have a lot, like I said, we have a lot of transparency with the companies. They're constantly putting updates and we verify those updates with our expert network. We have partnerships with studios that help grow these businesses, make sure that they're real businesses, but we'll never bake out the fraud. But that fraud is baked into the economics of our platform.
Yeah, interesting.
We're also planning on there's 4 circles in our logo, and they represent every stakeholder in the venture capital ecosystem. And we privately score and credit whether you're an advisor, everything goes to the platform, whether you're an investor, whether you're a founder, whatever you are, a service provider. We score and make sure that only the best people are making contributions to our community.
Mm-hmm. Yeah, interesting. Moving on, the next question I have for you is, so talk about lessons learned from the other side of the table and critical insights you gain about what founders and investors don't always share, and discuss limitations investors often face in assessing the quality and investment readiness of startups and lack of consistent data-backed evaluation in early stage investing.
I'd say there's no data in early stage investing, and there never will be, because the markets change so rapidly and the industries change so rapidly, and we're seeing a more move towards deeper and deeper technologies. The idea that I'm sure there's some check marks that you do in due diligence, But the idea that there's any predictable data in venture is extremely flawed. And because we're moving to deeper and deeper tech, a lot of the generalists that are in venture capital are going to be left behind. And even some of the specialists, things are just changing so rapidly. A lot of the things that you do in a fund one, you try to apply them to fund two and they just don't work. And we see that in the empirical data there. Fund two often performs worse than fund three, unless you're one of the big firms that, like I said, can help with their network kind of power through and maximize the surface area of success. Anyone else, it's really an unpredictable investment asset. What we try to do is we just try to have a more contrarian strategy around how we get liquidity and compound that liquidity by just being average. We don't expect to be top tier, but you can be average and be a very above performing fund or company just from adding in basic finance, which is the liquidity and the real analysis. I think the power law is a misunderstanding. The power law is a lot of things obey the power law. Gambling has a power law. Parlays have a power law. I think the challenge is people are focused on that long tail win. But really, what I've seen in the last 5 years, last 10 years in venture is that you're not going to see the Airbnbs and the Ubers and the Facebooks anymore. You're going to see deeper tech that's going to transform our world, that needs a technical expert, a consensus of technical experts and people in industry and analysts to really qualify that deal at scale. And that's really what's missing in the industry.
Oh, what does it mean for you to invest smarter, not harder? And how does building Cyrannus exemplify that?
Yeah, so focused on the short tail of the power law, you can have amazing economics if you can just fraud as one of the things, but things that had no shot of success. And I see VCs investing in a lot of deep tech things that have no shot of success. You'd be amazed at the number of climate tech deals that are done that violate the first and second laws of thermodynamics. And then you have all the market problems you have to worry about. It's quite obscene looking at the investment climate. And I think it's being reflected in LPs now. LP sentiment's at an all-time low. They're not dumb individuals. They know that their money could compound a lot easier in other asset classes. And when you lose faith in an industry, you're making deals you don't understand, and you can't call someone up and get the information you need. And that due diligence process is broken in itself because people that you call up, they probably don't want you to shoot the messenger. They probably want you to call them again. And they may not have a really good snapshot on the industry. Like, I mean, I'm a physicist. I wouldn't say I understand quantum physics, but I know quantum physics. I use it as a tool. But the idea that I could evaluate on my own a quantum computing startup technology or market would be silly.
Mm-hmm. Yeah. Final question is, how does your background with a PhD, obviously in research and academia, how did that help you go become a startup founder, raise venture capital, be in this whole startup ecosystem?
Yeah, I always want to be part of the next big thing. That cuts both ways. Often you're very early. But it gives you insights that asking experts alone probably is not a great idea. Asking technical experts specifically alone is not a good idea. They often don't understand markets work and how investment works and how the world really works. But on the flip side, if you don't have access to that, you're setting yourself up for failure. And so I think being able to straddle both of those things puts me in a unique position to understand what can be true. How do we validate something's true? What is predictable data? What's not predictable data? But on the other side, understanding that we all are taking moonshots on things that have a very low success rate, and putting that all together in the context of an investment firm, I think is a unique sort of skill set for myself and those around me.
Yeah. How can people find out more about you and reach out to you and check out your work?
Yeah, download the app. We're in the Play Store. We're in the Apple Store. Go to our website, cyrannus.io. Take a look at the product. It's very video forward. So we have a newsroom where, podcasts like this and other venture and startup community-driven content is created to help the ecosystem. And then we have a section where you can scroll elevator pitches and dig deep into the deals that are on the platform. And I think we're 200 deals now on the platform. We launched in August. We're growing anywhere from 20 to 30% week over week. We started doing some deals Q4 this year, and we're going to really ramp up here in Q1 of next year. We do have 100 million in family office support behind us. It's not like we're a network of angels. We're going to put our money where our mouth is. If you're a founder and you want access to some great feedback from amazing human beings that we've curated, and you want a shot at getting funded in 2 to 4 weeks, then you should check out the app.
Yeah, excellent. Thanks so much for coming on and describing, and happy holidays, and keep up the great work.
Thanks for having me on. I really appreciate it.